acquisition gains and costs. So what is the economic gain associated with an acquisition? Well, it's actually a pretty simple formula. Some of the questions that could be asked, and this may get a little bit tricky, but the formula itself, the thought process, is really pretty straightforward. Basically, the economic gain is taken by using this formula, is determined by using this formula, and what we're going to do is take the value of the combined company and subtract out the combination of the values of the separate companies before the acquisition. So let's say that we have company A was worth 100 million and company B was worth 50 million before the acquisition. Well, then we'd add that up and that's 150 million. But let's say that the company together, the combined company, is worth 225 million. Well, we take 225 million, which is the combined value of the company, and we'd subtract out the value of A and B added together, which was 150 million, and that would give us a gain, an economic gain on the combination of $75 million, okay? Now, the acquisition only makes sense if the economic gain is a positive number, right? Because if it's a negative number, that means that the combination is economically losing money. So why do it? We'd only want to do an acquisition if we believe that the combined company is going to be greater in value than the sum of the separate companies together, okay? Now, acquisitions are generally not regulated by the states. But in order to establish an offer price, the buyer has to determine the value of the target company. That's not always an easy thing. I mean, if the company is publicly traded, the target company, then it's easy to determine value because there is a value for their stock. If it's a private company, that's where it gets a little bit more tricky. The value can be determined using discounted cash flow or other model. There's actually valuation experts that what they do for a living is determine the value of privately held companies. Not an easy thing to do. The discount rate used to determine the value of a private company should reflect the risk associated with the business. Easy enough, right? Now, you don't have to, come up with values of private companies on your exam, but just keep in mind that in order to purchase the target company, the buying company is going to have to figure out approximately what they're worth, what the value is worth. Now, let's say that we're about to do the acquisition. We want to find out if the acquisition will benefit the buyers, the shareholders of the buying company, the shareholders of the selling company, both or neither. And we can use our formula from a couple of slides ago to figure out who's going to benefit. Now, the acquisition will create benefits for shareholders of both companies if the purchase price paid is greater than the pre-acquisition value of the target company and less than the sum of the pre-acquisition value of the target company plus the overall economic gain from the acquisition. What in the world does that mean? Well, I think probably for something like this, it would be best to look at a numerical example. And we're going to come up with a numerical example in our practice question, and then I'll go through that and we can see who's going to benefit here and who doesn't benefit and that sort of thing. I realize it's a very complicated slide that I just read. So let's hold that thought. We'll come back to that. Now, acquisitions can be paid for with either stock of the acquiring company or cash. An acquiring company is likely to use their own stock to make the purchase if the management of the acquiring company believes that their stock is overvalued. And the reason that they would use their stock to purchase the target if they think their stock is overvalued, because they won't need as many shares to be able to purchase the target if the stock is overvalued. An advantage of using stock is that if the stock of the combined company does wind up declining in the future. We don't want it to do that, but it happens, right? If the stock of the acquiring company declines in the future after the acquisition, the target company shareholders will also share in that loss. So that is one advantage of using stock to finance the acquisition. The stock acquisition should use the expected share price after the acquisition in determining how many shares will be needed to buy the target company. Okay, so let's go through this practice question. Now, Here's a scenario in which one company acquired another company. And we need to figure out what the overall gain was and which shareholders of which companies benefited and which did not. And that confusing slide that we saw a couple of slides ago, we're going to put that to the test here. So let's take a look. In an acquisition that was financed completely with cash, Purchase Co. P acquired Target Co. or T. The value of P before the acquisition was $300 million, and the value of T before the acquisition was $100 million. So when we add those two companies together before the acquisition as separate companies, there was a total value there of $400 million, okay? Company A and B separately was worth $400 million total. After the acquisition, the value of the combined company was $450 million. Okay, so let's go back a couple of slides. Here's our formula. We have $450 million minus $400 million. So that means our economic gain was $50 million. So that's the first thing you want to note. Economic gain was $50 million. 450 minus $400 million. Okay, now, assuming P paid $130 million cash to buy T, which one of the following statements is correct? Now, before I read the answers, let's take a look and see what happens. We know that the economic gain was $50 million, okay? Now let's look what happened. P paid $130 million to the target company shareholders, right? So let's see, did the target company shareholders have a profit here? Well, the target company before the acquisition was worth $100 million, wasn't it? And the shareholders got paid by P $130 million. So the target company shareholders have a gain of $30 million, don't they? Makes sense, doesn't it? Now with that said, since we have an economic gain of $50 million, okay, and $30 million of that economic gain went to the target shareholders, didn't it? Because they got $130 million and their value was $100 million. So of the $50 million of economic gain, the target shareholders received a gain of $30 million. That means that the shareholders of the purchaser had a gain of $20 million. Does that make sense? We know that the economic gain was $50 million, and there was a $30 million gain that went to the target shareholders, which means the other $20 million of that gain went to the shareholders of the parent, of the purchasing company, okay? So let's keep that in mind as we go through these questions here, or these answers. The value of the total economic gain from the acquisition was $30 million. Well, that's false. The value of the economic gain was $50 million, so A is out. What about B? The T shareholders, the target shareholders, received a gain of $50 million. Also false, because they received $130 million, but their company was worth $100 million. So their gain was $30 million. What about this one, C? The P shareholders received a gain of $20 million. That is true because P paid $130 million, okay? And when you add in the gain here, it's what, a $50 million total gain, economic gain. $30 million went to the target shareholders. That means the other $20 million goes to the purchasing company shareholders, which makes C our answer. And then we have D, the value of the total economic gain from the acquisition was $130 million. Well, we already said that it was $50 million, so C is our answer. Hopefully that makes a little bit more sense. With that said, if you look back at that slide that we talked about a couple of slides ago that was really confusing, and you use these numbers, you'll see how it all fits together. But once again, C is our answer. So let's talk about the mechanics of an acquisition. I mean, when we're going to acquire another company, that certainly represents an investment opportunity. And so we need to determine the value, and that's created by the risk and return trade-off. So when we're going to acquire another company, we need to realize that there's both advantages and disadvantages, and there's certain things that we need to look at, including due diligence, tax aspects, and financial aspects of the acquisition. So let's take a look at those different concepts, and we'll start with due diligence. Due diligence is the process of reviewing the target company's finances and management. It includes accounting, legal, insurance, finance, and other areas, okay? And what's great about due diligence is that if it's done appropriately, it can reduce risk, exposure, and increase value. Okay, so we want to just really check out the target company and just make sure that they're an appropriate investment for us. If we have insufficient due diligence, that may result in failure to expose risk, and it may result in an overvaluation of the target. We might wind up paying too much money if we don't do our homework, if you will. Now keep in mind that the management of the target company does have some responsibility as well. We can sue them, and I mean they're responsible if they intentionally misrepresent us and mislead us. Excess due diligence, it can be kind of a difficult situation to be in, because if there's insufficient due diligence, we may get ripped off. If there's too much due diligence, the target company might start getting angry at us, and it might really strain the relationship between the buyer and the target. So you got to be really, really careful. Sarbanes-Oxley, that act actually increased the amount of due diligence that needs to be done. So it made it a little bit more time-consuming and a little bit more restrictive. Now there's also tax aspects of an acquisition. We've got two different types of acquisitions. There's the taxable acquisition and the tax-free acquisition. The taxable acquisition occurs when the purchasing company pays for the target with cash, okay? Payment made by the buyer in cash, the target shareholders will have capital gains or losses. You remember in the last section, we had that example where the shareholders of the target corporation had a $30 million gain. Well, if you remember, that acquisition was financed using cash. So the buyer paid cash to the target shareholders. And as a result, that was a taxable acquisition, so the target shareholders will have a $30 million capital gain. They'll pay tax on that. Now, in a taxable acquisition, the assets are revalued, which may result in higher depreciation deductions. That's a good thing, but still there's going to be that capital gain, which is the bad thing. Under a tax-free reorganization, well, there is no increase in the value of the assets, which means our depreciation deductions will not change at all. But the good thing about a tax-free reorganization is that the target shareholders don't have to pay taxes on any gains or anything like that. A tax-free reorganization is usually accomplished with payments being made by the buyer in stock. Now, financial aspects include things like solvency. Solvency is a key area of concern for insurers. The buyer should review the financial statements of the target to determine any insolvency risk of the target. The buyer should also determine if there are any loan covenants or any other restrictions before purchasing the target. Purchaser may be willing to pay more than the value of the target's tangible assets. I mentioned a concept before. Let's say that there's a company out there that I would like to acquire, and the value of their total assets, which includes their buildings, their cash, their equipment, their inventory, is $2 million. Yet I pay $3 million for the company. Why would I pay more over and above the value of the company's tangible assets? Well, the reason is because the target company may have a certain amount of expertise, certain competitive advantages, maybe brand name, something like that, which is an intangible asset. So that's why I paid the extra amount. Now, with that said, when I pay the $3 million for a company that's assets were worth $2 million, when I show that company on my balance sheet after I bought them, I'll probably have that extra $1 million that I paid showing up as an asset called goodwill on my balance sheet. It's an intangible asset that actually gets me some nice income tax deductions and can save me some money there. But goodwill represents that additional amount paid for a company over and above the value of its tangible equipment and other tangible assets. So let's do a practice question. Which one of the following statements is correct regarding the mechanics of an acquisition? What about A? A reduction in the value of a company's goodwill as a result of an acquisition can improve the overall cash flow because less inventory will be needed. Well, that's close to being true, but it's actually false. I mean, certainly the goodwill can get me some extra tax deductions, which will save me money there, but that does not mean that less inventory is needed. So A is not quite true. So A is false. What about B? If the purchaser uses stock to buy the target company, the shareholders of the target company will recognize capital gain at the time of the purchase. Well, that's false. When it's a stock acquisition, an acquisition that's paid for in stock, that's a tax-free reorganization, so B is false. After a taxable acquisition, the company's assets are revalued, which may result in higher depreciation deductions and an increase in pre-tax cash flow. Well, that sounds true. That's another one that sounds like it could be true, but it's false because even though the company's assets may be revalued, resulting in higher depreciation deductions, depreciation is not a cash savings, not a pre-tax cash savings. Depreciation is an expense that does not result in cash outflow. So there is no increase in pre-tax cash flow. Now there would be an increase in after-tax cash flow because the depreciation deductions would save me tax dollars, but there is no change in pre-tax cash flow because depreciation is a non-cash expense. So C is false. I know that's a very tricky one. What about D? Insufficient due diligence performed by the buyer may result in failure to expose risk and thereby result in an overvaluation of the target company. Well, D is our answer, so D is correct. That was a little tough because a couple of those answers were pretty close to being true. But D is the correct answer. Okay, well, let's wrap up Module 11 by talking about some takeover defenses. Let's say that our company is being taken over and we don't want that to happen. What are some things that we can do? Well, as I mentioned before, takeovers can be either friendly or hostile. Let's assume for a minute that the takeover is hostile, and that means that we don't want to be bought out. But as you know, sometimes through some of these hostile takeovers, there may be a significant premium offered to our existing shareholders, something they can't refuse, right? Remember the bear hug from earlier in this module? So let's talk about some defenses that we can employ to potentially prevent a hostile takeover. Well, one defense is a targeted repurchase. This is where we, and I'm going to assume for the rest of the module that we are the target company that's being acquired, and we don't want that to happen. What can we do? Well, we could initiate a repurchase from this raider. So this person who's taking over the company, maybe they've bought 20% of our stock. We're really getting worried they're going to assume control. Well, we can buy the shares back from this raider. Unfortunately, we typically, to do that, have to pay a substantial premium over and above what the raider paid just to buy the stock back. So we're just doing everything we can, paying a lot of money to get the stock back so it don't get taken over. It almost sounds like a form of blackmail, doesn't it? In fact, the money that we're using in a targeted repurchase is often referred to as greenmail. Okay, so that's one potential defense. Don't like that one very much. Another potential defense, if we're being taken over, is to find a friendly buyer that's willing to purchase us. Okay? Maybe there's a friendly buyer out there that we could sell the company to that would prevent us from being taken over by someone we don't want to sell the company to. That friendly buyer is sometimes referred to as a white knight because they come to the rescue, right? There's also various defense strategies that we could employ that would make the takeover of our company more difficult. Those are sometimes referred to as shark repellents, and the next couple of slides, we're going to focus on the different types of shark repellents. Remember, these are things that we can do, agreements we can have in place that basically allow or prevent a raider or make it more difficult for a raider to take us over. So let's go through some shark repellents. The first type of shark repellent is a golden parachute. That's a severance payment to the executive if terminated. Maybe what we're going to do before we're taken over, we're concerned that we might be taken over someday. So what we do is we make agreements with all of our executives that says you'll get 3 times your salary and you'll get stock options and you'll get all sorts of bonuses and all types of compensation if if you're fired from the company after a takeover. And so that way a corporate raider that comes in and looks at our financial statements, sees these agreements in place, may be less likely to try and buy us out, right? Because they know that if they buy us out, if they want to fire any of our executives, they're going to have to pay them all this severance. So that's a golden parachute. A supermajority is another shark repellent. That's an amendment to the bylaws requiring a high majority of shareholders to approve any takeover. Easy enough, makes it more difficult for someone to come in and take us over. A staggered board is another shark repellent. That's where a portion of the board of directors must be elected each year, making it difficult to obtain enough board votes to approve a takeover. Another shark repellent is a poison pill. Okay? In this case, existing shareholders of the target have the right to purchase additional shares of the company at a discount to the market price. That's when a buyer acquires an interest. So let's say we have an agreement that says all of our existing shareholders, if the company is purchased by an outsider, or is starting to be purchased, an outsider acquires an interest, let's say, of 20% of the company or more, then the existing shareholders have the right to purchase shares of stock at a 30% discount from fair market value. What's that going to do to this outside buyer, to the raider? Well, it's going to dilute his or her ownership interest, isn't it? So if a raider buys 20% of our stock, that's a bad thing, but then all of a sudden the poison pill kicks in and all of our existing shareholders are buying stock at a discount. It's going to dilute the raider's ownership. So that's one potential shark repellent that'll help prevent a takeover. A poison put's another shark repellent. This time it's not the existing shareholders that have the rights. Under a poison put, we give existing bondholders. So our creditors have the right to demand repayment of their debt if the company is taken over. And so if a raider's coming in and they want to take over the company, they're going to see this agreement, this poison put, that says if they take over the company, then the creditors have the right to demand immediate payment of their debt.